If you locked in your mortgage rate back in 2021, I need to tell you something before your renewal letter shows up. Your payment is about to jump by hundreds of dollars a month, and the bank is not going to call to warn you first. Here's the number. A $500,000 mortgage locked at 1.99% in 2021. Monthly payment back then, $2,116. Renew that same mortgage today at 4.79%, and the payment becomes $2,716 a month. Same house, same family, same loan, mostly already paid down. $600 more every single month for the next 5 years. That is $7,200 a year that wasn't in your budget last week. I am Nick, and this is Boring Money Canada. Today I want to walk you through exactly why this is happening, who it hits hardest, and the 3 moves that can soften the landing before your renewal date locks you in. First, the part nobody explains clearly. A mortgage in Canada is not a 30-year fixed rate the way it works in the United States. You sign a term, usually 5 years, at a fixed rate. When that term ends, you renew at whatever the going rate is. There is no opting out. Back in 2020 and 2021, the Bank of Canada had its overnight rate near the floor, basically 0.25%, to keep the economy moving through the pandemic. 5-year fixed mortgage rates followed it down, under 2% for a lot of buyers. Then inflation showed up. By mid-2022, the Bank of Canada started raising its overnight rate aggressively to cool it down. 8 increases in about a year, taking the rate from 0.25% to 5%. Mortgage rates followed. 5-year fixed rates that were under 2% in 2021 were sitting near 5% by 2023. Rates have eased a bit since, but anyone renewing now is still moving from a 2% world into a 4 to 5% world. So if your term started in 2021 or early 2022, your renewal date is the moment that gap finally reaches your bank account. Let's go back to the math, because the dollars matter more than the percentages. $500,000 mortgage, 25-year amortization, 1.99% fixed. Monthly payment, $2,116. 5 years later, you've paid the loan down to around $419,000. That's the balance you're actually renewing. Renew that $419,000 balance at 4.79%, same 20-year amortization remaining, and the new payment is $2,716 a month. The increase? About $600 a month, $7,200 a year. Over a full 5-year term at that new rate, that's almost $36,000 more coming out of your household than you budgeted for when you bought the place. And that's a $500,000 mortgage. If you're in Toronto or Vancouver with an $800,000 mortgage, the same math pushes the increase to about $958 a month. Over $11,000 a year. Gone. With the house exactly the same as it was last month. This isn't a rare edge case. Roughly 1 in 3 Canadian mortgages renews every single year because 5-year terms are the most common structure in this country. Some chunk of homeowners is living through exactly this renewal shock right now. Here's the part that stings the most. The people getting hit hardest are not reckless borrowers. They're the ones who bought a reasonably priced home, qualified properly, and made every payment on time. The rate environment changed underneath them. That's it. Variable rate holders went through a version of this already, in real time, as the Bank of Canada hiked through 2022 and 2023. If you locked in a fixed rate back then, you were protected from that ride. But the renewal date was always going to be the moment you eventually met the new rate environment too. There was no version of this where the low rate lasted forever. And it's not only the homeowner who feels this. A renewal increase this size often means less left over every month for everything else. Groceries, the car payment, what used to go into the TFSA. The mortgage doesn't just compete with your goals anymore. For a while, it crowds them out. So what can you actually do before your renewal letter shows up? 3 things. None of them are magic. All 3 actually move the number. Move 1. Stop waiting for the bank's letter. Most lenders send a renewal offer about 4 to 6 months before your term ends. That offer is usually their posted rate, not their best rate. It is a starting point for negotiation, not a final number. A mortgage broker can shop your renewal against multiple lenders and lock a rate hold, often 90 to 120 days out, while rates are still uncertain. If rates drop before your renewal date, you get the lower one. If they rise, you're protected at the rate you locked. This costs you nothing to set up. It just requires doing it 4 to 6 months early instead of the week your letter arrives. Move 2. Actually shop a different lender, because a rule that used to block this just changed. Until November 2024, switching lenders at renewal meant requalifying under the mortgage stress test, proving you could afford payments at a rate higher than your actual contract rate. That stress test kept a lot of people trapped with their current bank out of fear they wouldn't qualify elsewhere. As of November 2024, Canada's banking regulator, OSFI, removed that requirement for straight renewals at the same amortization and loan amount. You no longer have to pass the stress test to switch lenders at renewal. That barrier that used to lock people into their current bank out of convenience or fear is gone. If another lender offers you a meaningfully better rate, you can actually take it now. Move 3. Pay down principal now, while you're still on your old low rate. Every dollar of extra principal you pay down before renewal is a dollar you will never owe interest on at the new, higher rate. Most fixed mortgages in Canada allow a prepayment privilege, commonly 10 to 20% of the original principal per year, penalty-free. If you have any lump sum sitting in a low-interest savings account, a bonus, a tax refund, an inheritance, putting it against the mortgage before renewal is a guaranteed return equal to the rate you're about to pay. There's no investment that guarantees you 4.79% risk-free. Paying down the mortgage does. There's a fourth option some homeowners reach for, and it deserves a clear warning: extending your amortization back out to 25 or 30 years to shrink the monthly payment. It works mechanically. Stretching that $419,000 balance back to 25 years at 4.79% drops the payment from $2,716 to roughly $2,370 a month. But you're not saving money. You're paying it later, with more interest added on top, because you're financing the same balance over more years. Use this as a short-term bridge if the cash flow gap would otherwise break your budget, not as a permanent fix. The honest order of operations. Shop the rate first, because that's free money with no downside. Pay down principal second if you have spare cash sitting idle. Only stretch the amortization as a last resort, and shorten it back down again the moment your budget allows. One more thing worth knowing if you're a first-time buyer reading this and getting nervous. The stress test still applies when you first qualify for a mortgage. You're required to show you could afford payments at your contract rate plus 2%, or 5.25%, whichever is higher. That stress test exists specifically so renewal shocks like this one don't sink a household that budgeted at the bare minimum. If you qualified properly at purchase, a renewal increase should hurt, but it shouldn't be catastrophic. The households in real trouble are usually the ones who stretch to the absolute top of what they qualified for, assumed rates would stay low forever, and never built any room in the budget for a renewal that didn't go their way. If that's you right now, the move isn't panic, it's math. Get your rate hold quote today, see the real number, and build the next 6 months of budget around it before the letter forces your hand. Let's put the whole picture in one place. Renewing a $500,000 mortgage from 1.99% to 4.79% costs you about $600 a month, $7,200 a year. 3 real moves change that number. Shop your renewal 4 to 6 months early with a rate hold, switch lenders if it's better since the stress test barrier is gone, and pay down principal now while your old rate is still in effect. None of those 3 things require a financial windfall. They require knowing your renewal date and acting on it before the bank's letter does the deciding for you. If you've been putting off checking your renewal date because the number scares you, that's exactly the number you need to see first. The gap between not knowing and knowing is the only part of this that's actually optional. If this helped you see your own renewal differently, hit like. It tells the algorithm to show this to the next homeowner who's about to get the same letter you are. And if you want more of this, the real Canadian numbers behind the financial decisions nobody explains clearly, subscribe. This channel is built entirely around exactly that. One last number before you go. If you do nothing and just accept the bank's first offer, that's potentially $36,000 more over this term than if you'd shopped, paid down principal, and negotiated from a position of knowing your own math. Borrowing money isn't about avoiding the increase entirely. Some of it is simply the rate environment, and nobody controls that. It's about making sure you're not paying more of it than you have to. Check your renewal date today. If it's inside the next 12 months, start the rate shopping process now, not the week the letter shows up.
I am Nick. This is Boring Money Canada. We'll see you in the next one.